Trump always chickens out. Wall Street has never been more sure about anything else. The so-called taco trades have been on fire since April 9th. How much more juice is left in the taco trades? What should you be doing with your money right now? The two most popular expressions of the taco trades have been the long US equity trade and the short US dollar trade. The long US equity trade is based on the belief that Trump does not have the stomach to follow through with his threats, especially tariff threats. The short dollar trade is based on the view that Trump's frequent flip-flops are making foreign investors more wary of holding US assets. Both of these taco trades have performed well. Since Liberation Day, S&P 500 is up 25%, while the dollar index is down nearly 6%. Wall Street has become so blasé about Trump's trade wars that even the option markets appear to have tuned off. Has the market become too complacent? What do sentiment, technicals, and valuation say about how stretched are the taco trades right now? While institutional investors have been driving the short dollar trade, retail investors have been driving the long US equity trade. Despite the fact that inflows into US equity mutual funds and ETFs this year have been slower than in 2024, retail buying of individual stocks has surged. Reports suggest that retail investors now account for 20 to 25% of daily volume of US equity trading, mirroring the 2021 peak. While public data on retail activity is scant, the performance of retail trading platforms says it all. The stock price of Charles Schwab has not been higher since the meme stock mania in 2021. The zero commission Robinhood has done even better, rocketing up 360% since Liberation Day. Robinhood attracts a young crowd with an average age around 30. Robinhood says 50% of its clients are first-time investors. Members of the American Association of Individual Investors are mostly in their 60s and have a median investment portfolio of over $1 million. These two types of retail investors cannot be more different. And yet it would seem that FOMO is catching up with the older guys. After S&P 500 hit a new record high, the AAII Sentiment Survey released on July 2nd shows that 45% of its members are now bullish stocks, an increase of 10 percentage points from the previous week. The spread between the bulls versus the bears jumped to 12, the highest since Trump's first week in office. If retail sentiment is nearing extreme, if not at extreme, institutional sentiment is more defensive. Commitments of traders reports suggest that asset managers have been reducing their underweight positions lately, while hedge funds are cutting back their long VIX positions. Our composite sentiment indicator that also incorporates put-call ratio as well as VIX is back to 70 as of July 2nd. 70 is elevated, but not yet at extreme levels that are usually associated with market mean reversion. Sentiment and positioning are difficult to measure. This is why we need technicals to help us complete the picture. This is especially so right now, given technical analysis plays a prominent role in shaping the investment decisions of retail day traders. RSI and stochastic oscillators are popular momentum indicators widely used to identify overbought and oversold conditions. Both of these two indicators suggest that S&P 500 is in overbought territory. RSI closed at 75 on July 3rd, while stochastics was close to 98. Our technical momentum indicator, which also incorporates the share of S&P 500 companies trading above their 200-day moving average, is now currently at 80. 80 is the highest level in 2025 so far. The last time it was near these levels was in the beginning of December last year, before a small sell-off set in. What about valuation? Wall Street consensus is that due to Trump's trade war, the US economy will grow only 1.5% in 2025 after the 2.9% growth in 2024. Wall Street thinks that the impact of the trade war on earnings growth of corporate America will be more limited. The implicit assumption is that sell-side equity analysts are forecasting a further improvement in the overall corporate profit margin. Whether this assumption is realistic or not, what is interesting is that the stock market seems to think that the consensus forecast is too pessimistic. Consensus EPS forecast for 2025 is down 3% since the start of the year, but S&P 500 is up nearly 7%. As a result, S&P 500 is now trading on a PE multiple of 25 based on current year earning estimates. The spread between 12-month forward earning yields and 10-year U.S. real yields places S&P 500 in the most overvalued territory since the dot-com bubble. So S&P 500 is expensive and technically overbought, with elevated bullish sentiment approaching extreme. It does not look good if you ask me. The risk of a correction clearly has gone up. It doesn't mean, however, a correction is imminent. What it does mean is that the market is very vulnerable to a sudden negative shock. As I discussed last week, such a shock could take the form of a turn for the worse in Trump's trade wars. If the stock market is betting that Trump will chicken again when things get tough, there are no reasons to think that U.S. trading partners are thinking differently. This is why I don't expect Trump to score easy wins with most countries like he did with the UK. In this respect, the Vietnam deal announced this week is not as positive as it may look, as the 40% tariff on transshipment from China is almost certain to harden Beijing's negotiating position. There are three important deadlines over the next 6 weeks. The end of the 90-day pause of the reciprocal tariffs on July 9th. The deadline for the negotiation with Canada on July 21st. The deadline for the negotiations with China on August 15th. I can see many ways things can go wrong, just when the economic impact of the tariff war starts to bite. And then there is the dollar. The weakening of the dollar over the past 2 months has helped fuel the rally in U.S. tech stocks on the currency translation argument. But a weak dollar will make it even more difficult for U.S. importers to absorb the tariffs. Toyota just announced that it would start raising prices in July. I suspect it will soon be followed by others. The Federal Reserve has good reasons to sit on their hands, as tariff-related inflation should start to pick up soon. Vietnam agreed to a 20% tariff. I suspect 20% is the new normal. The question is this already in the stock price? I don't think so. Call me a pessimist, but it seems to me that the breakout of S&P consumer discretionary over the past week is a dead cat bounce that should be sold into. Thank you for listening.